Stocks are sharply lower with the Dow Industrials and the S&P 500 entering negative territory for the year. From the Federal Reserve's looming rate hike to weakness in China, investors are fleeing stocks in favor of safer assets like gold and treasuries. So what's next for the markets? Michael Houston is the chief market analyst at CMC Markets and joins me now from London. And Michael, what do you make of this sell-off? Is it really about the Fed or something deeper?
I think there's a couple of strands to this particular story, Scott. One is obviously concerns that the Fed might hike rates next month. I think that's becoming increasingly less likely. I've said on a number of occasions I don't think the Fed will hike, but I think there is a perception within the market that they seem wedded to the idea. I think the biggest story at the moment is concerns about China. 77-month low on manufacturing PMI this morning, feeding into the narrative, the recent narrative of concerns about a much lower growth trajectory within the Chinese economy, coming on the back of the recent devaluation in the yuan. I think it's feeding into a little bit of a negative feedback loop, going into the fact that a slightly dovish set of Fed minutes weren't enough to actually push stocks higher. And essentially what we've got at the moment is a little bit of a risk-off trade going on.
Right, I want to ask you about that because it would appear that the Fed's initial rate hike isn't priced into markets. We got that dovish minutes report like you mentioned, but on the other hand, we also had pretty strong housing data this week in the U.S. that would warrant a September move.
Yes, but we've got inflation data that doesn't. So, it really depends on who you believe with respect to the health of the US economy. I think with the trajectory of oil prices and commodity prices in general, I think really the data, the underlying data, doesn't really support a US Fed rate rise. And we've certainly seen an awful lot of warnings from US companies about the effect that the strong dollar is having on their bottom line. So I think when you basically bring all that together, the fact that the Fed has a dual mandate, I think a rate hike could actually do more harm than good.
And for investors, what should they be doing right now? Is it time to hit the panic button and get defensive?
No, I don't think so. I think if you actually look at what the S&P 500 has done over the course of the last 2 or 3 years, we're still around about 70% higher than we were in 2011, 2012. And if you actually look at the performance of the S&P relative to other indices, it's still doing fairly well. I would be concerned if we drop below the 1975 level, which was the lows in November last year.
All right, but we do have more than half of S&P 500 stocks in correction territory at this point, but the index is only down about 3.4% for the week. Do you think we'll see that drawn out 10% correction that many investors have been waiting for?
I think we need to see it, if only to shake out some of the overbought factors within the market. If you actually look at broader markets across the globe, the US market is the one market that hasn't seen a significant shakeout. And when I look at some of the forward earnings projections for companies like Netflix, I think that there's absolutely no way they justify that sort of valuation. So I think what we really need to see, Scott, is a significant correction in not only the S&P, we're also seeing it in the Russell 2000 at the moment. That's just gone into correction territory. And I think it's a naturally healthy thing, given the gains, certainly in US markets, we've seen since 2012.
All right, Michael, we'll leave it there. Michael Houston from CMC Markets, thanks very much for your time. I'm Scott Gamm, and you're watching The Street.